G'day, ladies and gents. Welcome to the Flow Show, Tuesday, 9th September. And we're off and running nice and early today with volatility. Loving it, loving it. I said we're going to come back with a bang this from last week. And here we are, not being disappointed in the slightest with the volatility we're getting. Any difficulties trying to make money from it. But I'd rather have the volatility and not be making money than no volatility and not be making money. So we'll see what we can get at it. Right, let's get into things. Before we do, just to remind you, our sale is still on. I don't know why it's still on. It's supposed to be off by now. Summer's over. But you might be in the last week of being able to grab a 40% discount on our monthly subs. Get in quick. That won't be lasting long. And if you're in our chat room, then you'll get the fastest news on what's going on in markets and all the explainers of what's going on. And there's lots of stuff going on at the moment. Right, let's get cracking. Going to start in Japan. Lots going on over there, as you can imagine. We had a bit of data out first. Machine tool orders. This is the flash number coming in year on year, up 8.1% versus 3.6% expected. So a very good pickup there for that. We've had obviously the politics coming out as well. Firstly, we've had confirmation that the leadership vote is going to happen on the 4th of October. It's also going to be an open contest. So rather than select members of Parliament being able, so actual MPs being able to put their hat in the running, they're opening it up to the whole of the LDP party, members as well. So anyone in theory can throw their hat into the ring. This is something they're trying to do just to revive the party's fortunes. Maybe someone obscure will come in with some good ideas that will revive the party. But anyway, it's going to be a different leadership contest this time around. Maybe far more people, as I say, putting their hat in the ring for this one. So that's something we need to keep an eye on. It's going to make comments from a lot of MPs now a bit more pertinent. We've already had a guy, Taro Kono. He's an LDP MP. He's not a minister of anything, but he's talking about the BOJ, saying if the BOJ delays a rate hike, it will boost inflation. It says we need to fix the weak yen, so the BOJ needs to hike rates. So he's already out. Hasn't said whether he's in the ring or not, but as I say, a lot of people could end up in the race. So all these comments are going to be vitally important. Kyodo News has reported that Takaichi is going to intend to run for LDP leader. So she's the lady who was in the running last time, alongside the other guy. I can't remember his name. It was the Agriculture Minister, Koizumi, that's it. I don't know if we've had official confirmation that he's running again, but we're going to be getting all that over the days ahead. On to the BOJ and some early news dropping about an hour or so ago. Bloomberg, so take it as you find it. They reported a story that the BOJ sees the chance of a hike this year despite all the political shenanigans, as they say, and the economy has developed in line with expectations. So we've been saying it for a few weeks now. They've been taking steps. The economy's been taking steps. The data's been taking steps closer towards a hike. And now this sources piece is confirming that they may do just that. The piece, however, said that they are likely to keep rates on hold at their September meeting. They have seen that the US trade deal removes the risk to growth, and they still see steady progress towards the bank's price targets. There's been another sources piece from Reuters saying that the BOJ may cut JGB purchases in the 10 to 25 year range in October, which would look a little bit of a tightening measure as well. So we're gearing up, probably not September, but if the data continues, and we'll keep an eye on those real wages as well. And if the political mess doesn't derail things massively, we are potentially on for a hike. As you can imagine, yen's reacted by strengthening today, but I'll look at prices in detail shortly. Staying with the data into today, and you'll see that top number there. Now, I said on Friday after the UK retail sales, I expect August to be a decent month as well. Well, the BRC, British Retail Chamber, I think it's a British Retail Chamber or Commerce or something like that, Retail Sales Monitor shows year-on-year sales for August up 2.9%, beating expectations. So a very strong looking report there. That's year-on-year sales, not a monthly number. So yes, I am still expecting August to be decent on the retail sales front. I'm expecting that to go into reverse in September, but we won't get that data till later on in the year. But forewarned is forearmed, as they say. So that's good news. Bad news. British employers' intentions to hire has fallen at the sharpest rate out of 21 European countries. That's according to a recruiting report from the Manpower Group. So that's not good news. Firms not looking to hire, and that's fallen sharply. So that's something the Chancellor's going to have to keep an eye on. Also, the Bank of England as well. And speaking of the circus tent in Threadneedle Street, HSBC now expects the BOE to remain on pause in November and February, whereas previously they said they were going to cut in November and February. They expect the Bank of England to resume cutting rates from April 2026. Deutsche Bank have also slightly changed their call for the next rate cut. They've moved it to December from November. They all must be getting the summer buzz, because I think come September's round of data, which we'll probably get October, November, it'll be flipping the other way and calling for cuts ASAP, the way things are going, particularly once we get that budget out the way as well. So here we have the market, some in the market getting a little bit less dovish on the Bank of England, and I think that's all going to flip the other way in the latter part of the year. Barclays CEO says bank taxes are not a path to higher growth in the UK. A little shot across Rachel Reeves' bow there ahead of that budget coming up in November. Moving on to La France, and PM Bayrou did his best to sell why he shouldn't get booted out yesterday afternoon, then probably got booted out. He lost his confidence vote 364 to 194 in favour of him getting the heave-ho. So he's stuck his resignation in. Macron is going to announce a new PM in the next few days, and he's also going to put a revolving door on the PM's office, considering they've had so many in the last couple of years. Francis Le Pen says in these circumstances, Macron only has one possibility, which is calling a new election, something Macron has absolutely no real thought of doing. Where we go from here, no idea. The political mess is just going to rumble on and on and on. We'll get a new PM. We'll see whether he can cobble something together. A lot of this, remember, is all around the budget and France passing a budget, which they've not been able to do. So that's going to rumble on and on and on. The euro not really paying much attention to it at the moment. But it may come to a head at some point, particularly if we do end up a general election. ECB's Villeroy, he's a happy bunny. He's also the governor of the Bank of France, says we're in a good position with inflation in Europe. There's a kiss of death for you. Some data out the US last night. We got consumer credit coming in at 16.01 billion, higher than the 10.4 billion expected. So that's, on the face of it, potentially good news. It shows that the US consumer is pretty buoyant. So that should bode well for future retail sales numbers and whatnot. But it's something we will keep an eye on, because healthy consumer credit is one thing. Getting out or getting into debt because you ain't got the money coming in, you haven't got the income, is another thing altogether. There's always a fine line between consumer credit growth that's healthy and consumer credit growth that's problematic. We're in the healthy zone at the moment, but it's something we'll keep an eye on. The US Senate Banking Panel is going to vote on nominee Mirren to the Fed tomorrow. So that, if it all goes well and all the I's are dotted and T's are crossed, should see him in play or in the FOMC for the September meeting next week. A bit of a rush job going on there. Also, Trump, apparently his advisors are preparing a report on the alleged shortcomings of the BLS, and particularly the jobs data. That should be an interesting read. Reminder that we get the jobs revisions today, the benchmark revisions that I think are from March 2024 to March this year, or end of April this year. As you can see on the calendar there, it's coming at 1500 BST, which is 10 a.m. Eastern time in the good old US of A. Now, last time we got around about 600k loss. There was some wild numbers being thrown around, 800,000, a million jobs revision and all that stuff last time. We're in the same ballpark again. Market looking at around another revision of around 800,000. So, you know, it's a bit of a guessing game, but that's the benchmark that the market's going to judge that number against. What does it mean for the grand scheme of things? I mean, it's revising old stuff. All it's going to do is just say whether the US labour market was potentially more healthy or less healthy than things stand right now in the period from March 2024 to 2025. So it is a bit old news, but the market is focusing on the jobs data right now. We've had soft NFPs, so anything that's toppy, shall we say, 800,000 or more. That's probably just a bit more icing on the cake for further Fed cuts. So know what the market is thinking going into this number. Even if it is a better revision, say it's another minus 600 or better than that, minus 500, may see a bit of a lift in the dollar, but I don't think that's going to change things markedly at all, because the market's still thinking about cuts on what the current data is doing. Apart from that, there's not a lot else out this week or today as far as the data goes. Just having a quick look through, get myself up and running. Yeah, we've got a couple of speakers happening. BOE's Breeden will be waffling on later on this afternoon as well. SMB Schlegel will be speaking, and Germany's Nagel will be speaking as well. And not sure what Nagel's speaking about, because I thought the ECB would be in their blackout period by now. So that might be something that's not monetary policy related from Nagel, because obviously we've got the ECB on Thursday. That's all I've got from the headlines. It's not too busy on the headline front, but as noted, we've got a lot of moves going on. Now, if you're not in our chat room, there's a reason you might want to get in the chat room, because I've had one of my little, I wouldn't call it a rant, but one of my little write a book moments, talking about expectations, talking about hype, talking about how, you know, the market is all about, or let's say that the press to do with the market press, financial, FinTwit, whatever you want to call it. It always has a way of hyping things up. Okay, we had a lot of that hype on Sunday with this Ishiba stuff. You know, people talking about dollar yen shooting to the moon, 150s, 155s, and all this stuff. And look where we are now. We're 200 pips lower than the high we reached over all that Ishiba stuff. You have to know what the market knows. we always say this. We say it's about data points. We say it's about Feds. Know, or central bank meetings, anything. Know what the market is doing going in. Why wasn't the Ishiba thing more explosive? The market knew about it. Okay, the market knew Ishiba was leaving one way or another since he lost the House election earlier in the year. Okay, he was a dead man walking. The market knew that. It was how he was going to leave that was the risk to the market. That's what the market didn't know. Was he going to try and cling on? Was he going to try and cause a general election by dissolving Parliament? The rumour we got last week. All that stuff, there was knowns and unknowns. The market already knew he was gone. So when he did go, it's not a shock. It's a shock because we didn't know exactly when he was going to go, but he went, and he was going to go on Monday, potentially one way or another. So it wasn't new news. Yes, we get the volatility, and yes, we get the surprise action, but it all washed out yesterday. The bigger picture, as we've been saying, is what's going on at the Fed. As I said at the start of the show, as I said last week, is the market coming back with a bang. The NFP data is important. The inflation data this week is important. Last week's NFP, this week's inflation data is probably the most important data points we'll get this year, because it is setting up what the market is going to price for the next 3, 6, 9 months. Okay, that's what markets trade. They don't trade now, they don't trade tomorrow. They trade what it's going to happen, where prices are going to be, where assets are going to be, where rates are going to be 3, 6, 9 months time, because that's what big investor financial institutions do. They are looking for their profits over an extended period. They're not day traders. Okay, they want to know how to position to profit over the next 3, 6, 9, 12 months. Okay, so this period right now is the making and breaking of pretty much next year's trading. Okay, because once we've priced everything that's going on, once the market knows what the Fed are going to do with rates next year, because it's already got an idea what it's going to do this year. We've spent months and months pricing 2 rate cuts this year. We might get 2, we might get 3. Okay, there's not a big difference between the two. But if we get those 3 rate cuts, that puts the rate by the end of this year at the midpoint the Fed expect rates to be in 2026. So we will be at that level, at their 2026 median level. We will be at there in December. Okay, and the market knows that they're probably going to have to keep cutting, because if the job market is softening, if it's weakening, the Fed are going to want to get in front of that, and it's going to take more than 2 or 3 cuts to do that. So we're already looking forward to the year. This is where we get the repricing. This is why you get yields coming down. This is why you get the dollar looking offered every single day and rallies getting sold. But it's finite, because, as I say, to get down to 3%, which a lot of the market is talking about where the Fed would need to go, that's 50, 62 pips if you take the midpoint lower than where the Fed are already expecting next year's rates to be. Okay, so we're going to get 3 cuts this year. That takes us down to 3.625%. Okay, we need another 62 basis points of cuts to get us down to 3%. Call that 3 cuts, because, as I say, I'm talking about the midpoint between the Fed funds range. So we're potentially going to get 3 cuts or 2 cuts the rest of this year. We're going to get 3 cuts or 2 cuts next year, if 3% is the landing zone. Okay, that's not a huge amount of cuts. It doesn't mean the dollar is going to go, in dollar yen terms, from 146 down to 130. Okay, we're not going to see the same sort of thing. Let's put it on a wider chart. We're not going to see the same sort of thing over them cutting rates that we saw when they hiked rates and the dollar took off. Okay, yes, there was yen stuff going on within this rally as well, but inflation took off, rates took off, the dollar took off. We are still in the unwinding process of all those rate hikes when rates went to 5.5%, near 6%. Okay, so the window is very narrow. The margin is very narrow for how many more rate cuts we should get. We could always get more, but we should get. So 3% is sort of the landing zone the market's looking at. What it's going to do, it's going to see what the Fed does. What does the Fed think next year is going to be? If the Fed sees 3%, then all the price in the market's done. It's going to have a little confirmation move, and then boom, it's done. The market then moves into balance, and all we trade from that point is the data points. Does the data mean they might have to do more? Does the data this month mean they might have to do less? And then we get that little bit of swinging, and we get the ranges, and we get the consolidation, because we're tinkering with those rate expectations. So this is why a September meeting is so important, because the market's thinking 3% landing zone for rates next year. What does the Fed say? If the Fed says it's 2 to 2.5%, then the market's got more to price. If the Fed says it's 3 to 3.5%, well, it's not that far off where the market's at. So it's not got much more to do. Okay. So it will be trading next year, next week. And that's what you need to understand about expectations. Okay. And what the market is doing in. So if you think the Fed are going to cut 3, 4, 5 times, that does not mean the dollar is going to 130 in dollar yen. Just on that, it could go to 130 if the BOJ decide to hike 20 times next year, but that's an unknown. But just talking from the dollar side of things, there will be a limit to the dollar sell-off, and that's why you need to watch yields, because that will represent what the Fed is going to do next week, particularly on the short end. So we're in this period, we're in this flux. The dollar can move, the dollar can get sold more. It can also go up a bit, but I'm expecting after this September meeting, things will settle down a bit. Politics, everything else aside, just purely on the monetary policy aspect. So that's why you need to learn this stuff and understand what moves markets. That's why you need to know what the market is prepared for and what the market isn't prepared for. It was prepared for the Yeshiva thing, okay? It wasn't prepared if Yeshiva stayed on. It's prepared for the Fed to cut rates. It's not prepared for how far the Fed may cut rates. That's the final adjustment it needs to make. All right. So everything we get this week is with that in mind. 3, 6, 9 months in the future, not what's happening today. So anyway, where we are, dollar yen. Let's go back to that one. We've had a little breakdown. We did hold the range this morning. We're talking about this 146.80s, 148.80s. We held it after all the moves this morning, and it was the BOJ story that's really tonked it down. We've just gone through support down here, one of these sort of extension areas at 146.50. So we're looking like we're busting this range. We're just hitting this 146.25, 2030s area just down here, which we've tapped a few times. Bit of a level again, just a bit of a range extension when we've come under 147, 146.80. This might be a little bit of one line in the sand. We'll have 146, and then this 61.8 fib will be the big line in the sand. If we're cracking through that, then we're probably going to be heading down much further. I would suggest, if the Fed confirms or is maybe a little bit more dovish, we could see this down in maybe the mid to low 144s, particularly if the market's going to be pushing on the Bank of Japan as well. But again, we've had that headline, we've had that sources piece. We'll probably get others out of Japan closer to the meeting. The market will be pricing another hike coming in for the Bank of Japan. So any moves we get now is the pricing for not the next meeting, but the 2 meetings after it. Okay, pricing the future. So there is room to see this coming down to the low 140s on both the Fed and the BOJ, but I wouldn't expect more than that unless the data's falling off a cliff or something. So yeah, we got some lines in the sand down below, and this fib's going to be a big one because it's the part of this whole trend from last year. It's not part of the bigger trend. We've still got some bigger moves to take care of, namely the fib from there to there, which I haven't got on yet. I did have, I took it off. Can't remember, but this is just the trend from July, so it's pretty short term. And we've still got, as I said, we've still got the bigger trends to look at, which is all of this. Okay, nothing starts happening with that trend until we get down to the 139s. So trends within trends within trends. But for now, this is still going to be a rally sell, in my opinion. And despite me talking about laying out how things are going to go, the hard part is still making money from it. I looked at this 3 times yesterday to maybe hit it for a short. First time was Sunday night when it was 148, 40s, 50s. Then when I came in, it was still at 148. And then yesterday afternoon, I ummed and ahed about hitting it at 147, 70s. And I didn't do anything. And here we are, hundreds of pips lower. So I may know how to assess how markets think and move. Doesn't necessarily mean I'm always going to make money out of it. But I'd rather get my thinking right and not have a trade than get my thinking wrong and lose money. So yeah, rally selling from this point onwards. I'm now in a bit of a hope situation where I'm looking for hotter PPI and hotter CPI data to give me a rally to sell into in the dollar. But hope isn't a strategy, as we like to say. Right, let's have a look what's going on with you guys and girls. What are you up to, Ali? Busy as always. You went long cable, closed the trade. And you went long dollar CAD. Well, let's have a look at cable quickly. Let's get into a viewable picture. So this one's stretching its legs a bit. Again, this is all mainly on the back of the dollar, although that good retails number keeps the pound floating up, shall we say, because the data hasn't been that bad, but we're at a massive point up here in the high 135s into 136. We've had two big goes at trying this level. This might be the third knock on the door, is the one that lets it in. I think it's more likely than not that this moves higher, as I said, given that the market is happy to hit dollar rallies and keep selling the buck for now. So it's going to be, it could be a decent break or it could be a creeper. I don't think a lot of these dollar pairs are going to want to do too much ahead of that data. The PPI data tomorrow, CPI data on Thursday. Obviously, those benchmark revisions might be a mover today as well. So this week is going to be, as I famously like to say, and Kevin will pull me up on it, it's where we're going to close the week that's going to be important for this one. But I don't know why I'm not just buying euros, buying pounds, selling the dollar with my eyes closed, because I do believe it's going to go higher. But as I say, I'm going to look to see if I can grab a dip in some of these pairs or rallying the dollar to hit. But if we go here, we're probably, going to be sailing up 137s, maybe going on and test these highs. We've got a bit of a midpoint, 136.5. As is often the case with cable, there's always a lot of action around the 00s and 50s. So it's always something to keep in the back of your mind, just the way cable works. But that's going to be a really decent high if we get up towards that one there, 138s, high 137s. And it is possible that we could see that as well. What else are you looking at, Ali? Long dollar CAD. Where you go? That's just below 138. Yeah, that's not a bad area. I've been saying that if we continue to fail up here, we could get a steeper pullback. For me, this is a bit in the middle. We've got this resistance up, this level up here, 136.68, 60.70, and we got this support down here, 137.25, 35, which was a very decent support point when we were down here last. So this is pretty much in the middle of that. So this one's a bit more difficult to trade because Canada, they had an awful jobs report as well, so that points to further easing from the Bank of Canada, and obviously that's counter to what's going on with the US. The US will outweigh what happens in the US, will outweigh what happens in Canada as far as the market's concerned. It's more concerned about the dollar than the Canadian dollar. No offense to our Canadian friends. So this one might just be a bit more balanced. If the Fed do get dovish, then we're going to see a sell-off. But it may be a bit more limited than other pairs if Canada's going to follow suit and cut as well, because then the rate divergence trade is a zero-sum game from what it is now. So this one I can see sticking to the range, even if both sides get dovish. So for now, probably good range trading. Yeah, if we're holding below 138, Ali, then we're probably going to have a little look lower. Your stop loss is just below a little level I've got, so that looks okay as well. Next support under there is down at the 137.50s. So yeah, good luck with that one, mate. What else? Oh, you're doing lots and lots. Can I have a look at Kiwi and Aussie? Yeah, let's start with the Aussie, because breaky, we're back into the 66s. This one's taken forever to make a move, but here we are. We're back in the 66s. Can it hold this time? The last time we got up here, it couldn't hold for very long. We're just getting up to maybe test those prior highs, 20s, 66 20s. So that could be very important. If we top out there, that could be significant, at least for seeing a half decent pullback. But it depends how and when that happens. If it happens today, if it happens because of the data, again, this is probably a dip buyer's market again. So if you're not in anything, I don't know what you're doing, Mike. Let me know, long, short, square, whatever. But I would think that if that jobs revision's bad, we're probably going to take a look above that high. If it's good, we're probably going to dip, but I don't think that dip will last. Just to have a look at the wider picture, this 6630s, 6630s, 38s. It's one of those finicky areas that we've just sort of pivoted around. At some points, it's a bit of a zone-ish, probably 2040s. Just keep an eye on that. The bigger number though is up towards 67 and just below 6690s, because that's been a pretty big level as well, going back into last year and beyond. So that's going to be the next main level, and then we've got a big old level coming up at 68s if we get up that far. But this trend, it's been grinding along. You know, we were watching this all through the summer. Is it going to go? Is it going to go? Is it going to go? Then it pulled back and so on and so forth. It's got a chance of having a go now and moving on. So yeah, Kiwis. I'm going to imagine, if I can find it. Where's my Kiwi gone? There it is. Is going to look a similar picture. Still maintaining the bigger uptrend, not clawing back to these highs as quickly as the Aussie dollar. A bit of a drag from the RBNZ, who may not be done cutting rates, while the RBA don't know what they're doing. They're probably going to be cutting rates, but they're not in a rush to do so. So you've got a bit of a drag here still from the Kiwi. So you've got two trends. You've got this longer uptrend, and you've got this short-term downtrend, which we are respecting at the moment. Let's stick a little low level in now, just because I know some of you like this sort of thing. So potential break at the moment. So pullbacks to that 59, 40s, 30s area is what you want to be looking for if you want to be on the long side. Again, there we go. We've already got a bit of confirmation that this level's holding. Was the prior high back in the middle of August. So this is all confirming the break of that trend line and this level here. So if you're not long, then that's the sort of area you can try a low risk trade against if we get a dip in this one. You're looking to get long Aussie dollar. Yeah, same thing. you're a bit like me. You're waiting. So 65 90s looks reasonable for a dip. If you get one, that's the sort of area you want to try it. Maybe down to that 70s, but if you're gonna need confirmation in some of these dips, but if you're desperate, then you don't have to risk a lot. As I say, 65, 66, 65, 90s. If it's breaking under 65, 70s in the short term, then you're not going to risk much if you've got to stop below that level there. It's going to need something big to get us a dipping all the way down here. So for now, for today, this week, yeah, you're going to have to be a bit tight with your stuff. And here we are testing that level. Or you look for a break. If we get a break of 66.20s and we get a confirmation and it holds, again, another low risk trade. If you want to take that long around there, maybe a stop just under 65.90. Don't need to risk a lot. You don't want to be trying to pick a top for a break higher and then keeping your stops all the way down here under 65.50s or something like that. It's too much. Don't need to risk that much. Bran, you're fooling around. Don't fool around. Trade. We don't fool around in trading. You can scalp around. Don't fool around. What else? What else? Euro sterling. That's still going sideways. Thought it might be trying to hold out the top, but we're still faffing around in this bloody zone. Still no decision to be made. Still in the middle of this range, 86s, 87s. So feet up, popcorn, wait and see what happens and which way it goes. I'm still long, happy to be long, happy to stay long. I'll be less happy if we're breaking under 86. But I'll have to see the reason why we're breaking under 86. There, I'm going to, if it's nice to me, it will not do an awful lot until we get through to that part of the year when I'm expecting things to go a bit wonky in the UK, and then potentially this heading higher on pound weakness. But in the meantime, I'll probably just job it around between the ranges, 86s, 87s. If I get dips down there, I'll buy some, and if it rallies again, I'll let some off and just keep the core position. Same up top. I'm not averse to having a little short and just picking bits off the top if need be. Same back to down underland. Same for Aussie Kiwi. I was saying this one was important at this 111, 110.90. We did have a little pokey underneath, but it didn't last there long, and we're back above 111 again. So I said that the risk was that we found support somewhere in this area, and similar to this and similar to this, where it's just a short-term pullback and off we go again. So at the moment, this is really your pivot area, 110.90, 111. Whatever side we start to hold, properly hold either side of, is likely going to be the direction we go from that point. So for now, it looks like we could be maybe putting in another run towards that highs. Keep an eye on 1140 to 1150s. I would say there's more chance of a break up than holding again, but I'll do what the market tells me, not what I think it's going to do. Ali, your institutional investors question. How do institutional investors manage their big losses? Well, as I said, they don't day trade. Okay, they don't trade with stops per se. They will have performance targets. If they don't meet their target, if something's not working, they'll get out. It's not a stop level. They don't pick a number in a price and say, oh, if our plan doesn't work, that's the number we're going to get out. It's more of a discussion, okay? Because they're going to be in at hundreds of different levels. They're not all in at one price if they're banking on or betting on a particular asset. So it's really down to performance. They'll look at it, and this is why things like end of months, end of quarters, end of half years, end of years are important, because it's at those points where they go, right, what's the performance of this asset? Okay, this is the second quarter that it's been underperforming, it's not doing well. What do we think? Is it going to come back? or is this just a crap one and we need to get out and get into something else? That's how they move. That's why you get these big flows at these end of month, end of quarter periods, because that's when those institutions say, this ain't working, we need to bin it off and put it into something else. They're not like us. Don't think in our terms, oh, I'm trading this with a 30 pip stop and that's it. It's a bigger scale. They don't necessarily need to move as quickly, and they don't move as quickly as we can, because, as I say, they are trading for the future. They're not looking at making 100 pips a day. They're looking at making 10, 20, 30% returns over 3, 6, 9, 12, 15 months. Okay, and they judge their performance over a longer period than we do. So yeah, and we don't know what institutional investors do and what they're doing, but as I say, we get the clues with what happens at the months and quarter ends and when they rebalance in and out of various assets based on performance. Well, Blake, yes, he traded for a big prop firm, but that's not an investment firm. Just the same as I've never traded for an investment firm. I've traded business for investment firms, i.e. clients of the firm I work for. But it's a different kettle of fish being in that than being in a market maker broking capacity as I was, or as a trading capacity like Blake was, trading his own money and the company's money. So different. There's a difference between investors and traders like us. What else? Let's have a look at yields, because we always need to be looking at yields. So tens, they had a little pokey above that 409 level yesterday. Didn't last long. We're back below, holding below. We had a little run down towards 4%. I said that was the risk. It's still the risk. You can probably just stick a little line in there just to put a visual on it. So this 407 area is now important in terms of what yields are doing. If we're staying below there, more so below there, then we're going to put in a test of that 4% mark. Obviously, we don't do a lot of techs on yield because it's all about price. You trade the price, not the yield, but you can look at the price and see where the levels is pretty much the same in terms of price moves. So we're down here towards this 4% level. That's going to be a potentially big level. If we hold it, as I say, I'll be looking to maybe look to set up a range 4%, 420s. Again, hot CPI, hot PPI data, not too bad. Jobs revision today, we could see this creeping back up. I think we could get to 410s, 415s maybe. Be a big push to get to 420. And if we get up there and yields hold against that level, then any dollar rally is probably going to come to a halt as well. So that's my indication for watching what the dollar does over the next few days. And I'm more glued into yields for the dollar than I would be normally. Gold, let's have a look at the old metals. I've not updated my chart for ages. I really need to do a bit of a clean-up job on this one. It's off to the races, isn't it? There's not much to be said about this. It's climbing, it's climbing. It's had its break point. And when it has these big break points, it tends to fly. We've had many of these type of things going on previously. Look at that. We've even had, just chuck that in there, roughly. We've had the break and it's even held not long after. Technically perfect. Ran into that 35 area, and once it's broken, it's gone and gone and gone. And we've even had a half attempt at finding support there, not even getting close to that level again. Anything you need. What's he going to do now? He's going to keep going. What do we have to do? We have to do everything that makes my chart a mess. All these hundreds of lines is when we were looking at this intraday on the short term, finding when this was breaking up to new all-time highs, where it was stopping, what needed to happen next. it's, again, you got to build the picture. You got to do all the hard work again, define where the levels are going to be. Let's have a look, see if we can pick a few out. As I say, I've not been watching this too much. So we got one in there that we can keep an eye on. What's that? 3640s. Just it's going to be a couple of pips here or there. Okay, so let's call it that. 3840, something like that. Okay, that's your intraday level to watch. We're holding that, it's going to push higher. We're getting below that, it might break down. Where it's going to break down to next, maybe down to there. What's the next level under that? Probably around there. Okay, so we've got, you can do this yourself. When you've got markets going to all-time highs, there's no price history to rely on. All you can do is just look at where the market may do something again. Okay, doesn't mean you have to trade all these levels. All you want to do is wait to see which ones show up, which ones are stronger. This could do this and make all that in there invalid. But if it bounces off that one, faffs around, then bounces off that one again and does a lot of messing around, you know now that you can discount this level and this level, but you pay attention to this one. And you just do the price building. It's called price discovery, level discovery. You can put in as many lines as you want, but you just wait for confirmation that they are going to become something and which ones are stronger than others. And you can take them out, adjust them. Slowly but surely, you'll end up with the levels that you can really rely on. And those are the ones you can look to trade against. Okay, so do your homework, build your charts. Addy, I understand that US 2-year yields is a true reflection of expected rate cuts. How does one assess trends in respect to the dollar and other markets? It's a good question. So obviously the 2-year yield is a great reflection of short-term rates. So where's the Fed at? Okay, the Fed's dots have been at medium 3.5 to 3.75 in 2026. Okay, that's where they think, most of them think that rates will be by the end of 2026, 3.5 to 3.75. So that's your range. We're right in the range, but we're at the bottom of that range at the moment in 2-year yields. Okay, because the market has seen the NFP data, 2 lots now, worse revisions, Powell mentioning the Fed. So again, we're seeing this down, but it's not massively down. You know, it's not the market saying, oh, rates are going to zero or anything like that. It's the market saying, okay, we certainly, it's the market saying, yes, we need to be a bit more dovish on rates. Now, so 2-year yields, as I say, they're reflecting what's happening next year and obviously the year ahead. So they are a good indication of if the Fed is going to be more dovish, then these yields are going to come down. We'll probably move down to 320s, 330s, something like that. 10-year yields is a good general watch of the dollar in general. Okay, we know that dollar yen follows this an awful lot, so it's a good indication of what's happening there. We did have a little bit of divergence going on between yields and the yen when we were first coming down through 420s down to 410s. Dollar yen had moved down, but it also was holding up a bit, so there was a bit of divergence. This gives you, if you're trading something like dollar yen, watching a 10-year yield when the correlation is strong will tell you when moves in dollar yen are potentially going to run into trouble, because as soon as yields hit some decent levels, or the price hits some decent levels, it's going to put the brakes on the dollar, or it's going to move the dollar forward. The only thing you have to be careful with is they are 2 separate markets. So if you get a big move in yields, the dollar may move, but then Forex traders are going to have their own levels where they're going to say, well, okay, the dollar's moving enough. And then you may get a quick switch off of the correlation. So if you get big moves in yields, you'll get a big move in the dollar, but then the correlation can break down in the short term because we may have hit a huge level in dollar yen. Yields may keep going, but FX market are going, no, that's enough for dollar yen. So yes, your 2 years are more reflexive of rates. Your 10 years is a better rule of thumb to monitor the dollar. Obviously, it's rate market driven as well, but it's a longer view. And then you're getting into talking about the curve. How does the market see rates? The market still sees rates higher over the long term than the short term, okay, which is why all these yields, US yields, are lower in the short end than they are at the long end, because yes, rates may come down in the short term, but over a longer horizon, rates are still expected to potentially go higher or stay higher. So no one's expecting rates to go back to zero. And then you get your curve inversions and all that sort of stuff, which I won't go into today. Is that because Japan owns US 10-year bonds? Well, yeah, probably the 10-year market is probably the biggest market. And yes, a lot of people own that. But remember, buying bonds also affects yields. You know, price up, yields down. So if there's a lot of buyers, it's going to stop, you know, yields from rallying too much. Yes, they are holders, but there's also maturities. If you've been holding bonds for the last 10 years, they're going to mature. So you either replace them or you get your money back. And you can also sell the bonds if you're making money on them. So it's, for you and me, watching things like 10 years is a good reflection of what the dollar may do, how far a dollar move may go. Oh, blimey, that's time's trucked on. But yes, the correlation between dollar yen and yields is a lot to do with that as well, Addy. Woof, right, well, that was a good show, a long show. We flew through that. So I'm going to call it a session, boys and girls. I think Kay will be back tomorrow. Yeah, keep an eye for those revisions. Big day tomorrow with the PPI data coming as well. So trade safe. Get in our chat room if you're not. Don't miss out. And we'll see you tomorrow. Have a good one.